Namaste. Financial assets impairment. Impairment under Ind AS 109 of financial assets are based on the expected credit loss method under Ind AS 109. The expected credit loss model it reflects the deterioration or improvement in the credit quality of financial instruments. So the amount that we are going to be recognized as allowance for impairment of financial assets or reversal of allowance that we have already recognized as an impairment loss will depend on the model of ECL, that is expected credit loss model. And it is expected that under ECL model in India's 109 will result in much earlier recognition of impairment as compared to the incurred loss model that we have traditionally used. So, in the traditionally used model, amount of loss is recognized when the damage is done and it was blamed for the credit crisis at the end of the last decade. So, it was a major issue of the criticism of traditionally used incurred loss model. Because of that, ECL model was developed where loss is recognized much earlier as compared to incurred loss model based on the expectation of occurrence of the loss. Impairment requirements under Ind AS 109 are applicable on all the financial assets that are debt instruments and are measured at amortized cost. For example, it may be loans, debt securities, deposits, and bank balances, etc. Apart from it, financial assets that are debt instrument and those are measured at FVT/OCI. In that case, also the ECL model is applicable. Apart from it, the lease receivables, those are covered under Ind AS 116, are subjected to impairment requirements under ECL model of Ind AS 109. Similarly, the trade receivables under Ind AS 115 and contractual rights to receive cash or other financial assets resulting from transactions under Ind AS 115 are also subjected to impairment requirements of Ind AS 109. And loan commitments which are not measured at FVTPL and financial guarantees contract which are not measured at FVTPL are subjected to impairment requirements under Ind AS 109. And Ind AS 109 is not applicable for impairment on all the financial assets that are equity instrument because these are measured either at FVTPL approach or at FVTOCI. Apart from it, financial assets that are debt instrument as measured at FVTPL are also not subjected to applicability of ECL model, and any other financial instrument that is measured at FVTPL is not subjected to impairment requirements of Ind AS 109. For impairment of financial assets, Ind AS 109 provides us three approaches to recognize the impairment allowance on the financial instruments. First is the general approach, second is simplified approach, and third one is purchased or originated credit impaired financial assets approach. In case of general approach, entities required to recognize at each reporting date using 12 months expected credit loss or lifetime expected credit loss method. In this case of 12 months ECL approach, typically the amount of the impairment loss is lesser because we are estimating the loss over a period of 12 months from the reporting date. While in case of lifetime ECL method, the amount of impairment loss allowance may be higher because we are estimating the chances of loss probability of default over the life of the instrument. It may be 5 years, 10 years, or 15 years. And this general approach is applicable to all the financial instruments except those are covered under simplified approach or purchased or originated credit impaired financial assets approach. In case of simplified approach, we are not required to track the changes in credit risk at each reporting date. as compared to general approach. In simplified approach, we need to recognize impairment loss on the lifetime ECL at the initial recognition only. In general approach, we are recognizing the impairment loss at each reporting date, but in simplified approach, we need to recognize impairment loss at initial level only. And the simplified approach is mandatory for trade receivables or contractual right to receive cash or other financial assets. Those are not having major financial component and are within the scope of Ind AS 115. And we have accounting policy choice for the financial assets. Those are lease receivables or trade receivables or contract assets within a scope of 115 and are having major financial components. In this case, we can either use the general approach or we can use the simplified approach for recognition of impairment loss. And once the approach we have decided, we need to apply it consistently, and we need to apply the chosen approach, either general approach or simplified approach, on all the items in that bracket, and it cannot be applied selectively. And the third approach, that is called purchased or originated credit impaired financial assets approach. This approach is applicable to the financial assets which are credit impaired at the time of purchase or origination. An entity need to assess whether there is significant increase in the credit risk for the purpose of providing impairment loss. If there is no increase in the credit risk, in that case, entity need to use 12 months expected credit loss method. And if there is a significant increase in the credit risk from the initial recognition, in that case, we need to use lifetime ECL method. However, subsequently, if there is a change in the credit risk and the credit quality of the financial assets improves, and there is no significant increase in credit risk since initial recognition, here we need to check, we need to focus that significant increase in credit risk we need to compare from the initial recognition, not from the end of the last financial year. So if credit quality improves and there is no longer significant increase in credit risk since initial recognition, in that case we will move from using lifetime ECL method to 12 months ECL method. India's 109 provides us three-stage model based on the change in the credit quality of the financial instruments. In that case, for the purpose of loss allowance, in case of stage 1, we need to use 12 months expected loss method. And in case of stage 3 and 2, we need to use lifetime expected credit loss method. And lifetime expected credit loss, we need to recognize if there is a significant increase in the credit risk since initial recognition. Financial asset will remain in stage 2 if there is a no objective evidence of impairment, but if there is it is credit impaired, it will move in stage 3. And for the purpose of interest revenue recognition, the financial assets those are falling in stage 1. Interest revenue recognition based on the ARI on gross carrying amount. Similarly, for the assets under stage 2, it will be on AIR on gross carrying amount. However, the assets those have been fall in stage 3, the interest revenue will be recognized based on ARI on gross amortized cost. It means gross carrying amount less the loss allowance that we have recognized. Here, if there is a change in the credit risk since initial recognition, if it improves, we will move from stage 3 to stage 2 or towards stage 1. And if it deteriorate, in that case, we'll move from stage 1 to stage 2 or stage 3 as the case may be. Expected credit losses are probability weighted estimate of credit losses. So credit losses are difference between the all contractual cash flow over expected life of instrument, including prepayment, call, and similar options, and expected cash flow discounted at original EIR. So this is the difference between the contractual and expected cash flow, though that has been discounted at original EIR. So here time value of money must be taken into account while calculating the ECL, regardless whether it is a 12 months or lifetime ECL. Here, should discount cash flow expected to receive at EIR determined at initial recognition or approximation thereto? If financial instrument has a variable interest rate, in that case, ECL should be discounted using current EIR, and cash shortfall cover overall shortfall in collection against the contractual term, not just shortfall on a particular date on which cash is received or due. For example, if installment was due in January, there will be shortfall in January, but if that has been recovered, expected to be recovered in June, so there will be a difference because of the discounting factor only, because principal amount instead of January we have received in the month of June. So to calculate the shortfall, we cannot ignore later recoveries of missed payment on due days. It means that in delay collection, only time value of money factor will impact ECL, not the amount of principal if the amount has been received on a later date. India's 109 does not prescribe any specific approach to estimate ECL, but it requires that whatever approach the entity is using, that approach should reflect unbiasedness and probability weighted amount that is determined by evaluating a range of possible outcomes, the time value of money, and the reasonable and supportable information that has been received, that can be received without undue cost and efforts at reporting date about the past event, current conditions, and forecast of future conditions. So this is all about the expected credit loss. Respect of purchased or originated credit impaired financial assets, Ind AS 109 require an entity to determine whether a financial asset is credit impaired at the time of initial recognition. The evidence that a financial asset is impaired include observable data about such events. So Ind AS 109 provides us the list of indicative events. Based on that, we can decide about the impairment of financial assets, whether there is a significant financial difficulty of issuer or the borrower, if there is a breach of contract such as default or past due event, lender or borrower for the economic contractual reason relating to the borrower's financial difficulties has granted to the borrower a concessions that lender would otherwise consider. It is becoming probable that the borrower will enter the bankruptcy or other financial organization reorganization, and there is a disappearance for of an active market for that financial asset because of the financial difficulties, or purchase or origination of financial asset at deep discount that reflect the incurred credit losses. It may not be possible for an entity to identify a single discrete event. Instead, the combined effect of several events may have caused the financial asset to become credit impaired. For ECL determination, in respect of POCI financial assets, neither general approach is used nor simplified approach is used. And the key difference between the approach used for POCI ECL calculation versus general approach and simplified approach is determination of ERI method. In case of general approach and simplified approach, ERI is calculated by considering the gross carrying amount without loss amount and contractual cash flow without considering the expected credit losses. Similarly, for interest, it is calculated typically by applying EIR to gross carrying amount of the asset. However, in case of POCI financial assets, the standard Ind AS 109 require credit adjusted EIR to be calculated for POCI financial assets. Hence, for POCI FA, ERI is calculated after considering the initial lifetime ECL in estimated cash flow. And this approach is called as credit adjusted EIR. So we can say the adjusted EIR is a rate that exactly discounts the estimated cash payment or receipts throughout the life of financial asset to amortize cost of financial asset. For POCI financial assets, an entity recognizes in subsequent period cumulative changes in lifetime ECL since initial recognition are presented as loss allowance in balance sheet, and if expected cash flow has increased after the initial recognition, any increase is included as an adjustment to the amortized cost, and from PL perspective, amount of any change in the lifetime ECL is recognized as an credit impaired gain or loss. And if any asset that is that was not credit impaired at initial recognition but become as a POCI at a later date, in this case we need to measure ECL as below. There is no separate determination of credit adjusted EIR. We need to continue using original EIR which was determined at the time of initial recognition, and any adjustment in ECL is recognized in P&L as an impairment gain or loss. And going forward, interest income is to be recognized on amortized cost basis, not on gross carrying amount basis. So this is all about the recognition of subsequent measurement of POCI financial assets.